Hello, my name is Shannon Katz, and I'm a manager here at LGA in the Audit and Assurance Department. And this is my colleague, Adam Shaker, who is also a manager in the Audit and Assurance Department. Thank you for joining me today, Adam.
Thank you, Shannon. I'm happy to be here.
Today we are going to discuss some of the changes that may have occurred related to your 401k plan during 2020 as we approach the benefit plan audit season this year. So Adam, what components of the CARES Act affected everybody?
So one of the big things that the CARES Act changed was it completely waived any required minimum distributions during 2020. So prior to the CARES Act being signed in 2019, there was a new law called the Secure Act that increased the required minimum distribution age from 70 and a half years old to 72. So in 2020, all of these were waived, but now that we're sort of out of 2020, you're going to start seeing these again.
All right. Other than the required minimum distributions changes, are there any changes that affect specific individuals?
Yeah, so most of these changes that the CARES Act made were for what they called qualified individuals.
Okay. And how do I know if I'm a qualified individual?
So a qualified individual was anyone who had adverse financial consequences due to COVID or anyone in your household. So this ranged anywhere from, if you contracted COVID or if you had to quarantine and you were out of work for a while, if you were laid off or furloughed, if you had reduced hours, even if you were unable to work because your child care was kind of stopped during that period. That counts towards being a qualified individual. And even if you have a new job offer that got delayed or it was rescinded, then that would also count as being a qualified individual as well.
Okay. And for these qualified individuals, what were some of the changes that occurred as a result of the CARES Act?
So the big one for distributions was that there was a new type of distribution added. So they called it a coronavirus related distribution. So if you were a qualified individual, you had basically the option to take up to $100,000 distribution that wouldn't be subjected to the 10% early withdrawal tax if you were younger than 59 and a half years old. It still would be subject to normal taxes. However, you're allowed to defer that tax ratably over 3 years. So an easy example would be if you took a $9,000 coronavirus distribution, you could essentially report that taxable income as $3,000 for each of 2020, 2021, and 2022 to sort of relieve the tax burden a little bit. There are also a couple changes for loans. The first one being if you had any loan repayments that were due from the date that the CARES Act was signed, which was March 27th, 2020 through the end of the year, you had the option to basically suspend those payments for a year. So what basically, since your payments were being delayed for a year, your payment schedule is going to change. It's going to get re-amortized to factor in the accrued interest during 2020 and then extend it for the period that it wasn't being paid for. So if you're a plan administrator, it's important that you're aware of this because you're going to have to go into your payroll system and restart those withholdings. And if you're an individual who had a 401k loan, you're going to want to make sure that your payments were restarting as well, because if you don't make the scheduled repayments, your loan could end up going into default and it could be taxed as a distribution. Another change for the loans was that for qualified individuals, the loan limitation increased. So the CARES Act, for any loans taken out between the signing in March and September 2020, the limit was increased to $100,000 or your vested balance in your account, whichever was less. Prior to the CARES Act, the limit was $50,000 or 50% of your vested account balance. So basically starting in October of 2020, the limits are going to revert back to that $50,000 and 50% that it was before the CARES Act.
Wow, that seems like a lot of changes. Can every qualified individual participate in these changes?
So even if your employer doesn't adopt these changes, if you took out a coronavirus distribution and you're a qualified individual, even if your employer didn't adopt this change, you could still treat that distribution as a coronavirus distribution for tax purposes. So defer those payments over 3 years and not be subjected to the 10% tax for early withdrawals. Obviously, there's if your plan, some plans don't allow for loans, so you wouldn't have been able to utilize those even if you were a qualified individual. But for the distributions, everyone can basically consider their distribution a coronavirus distribution if you're a qualified individual.
Excellent. So besides changes issued from the CARES Act, are there any steps I can take now in the current climate to help with my 401k loan balance? Can I refinance my loan?
Yeah, so now I think everyone's probably aware that the interest rates have decreased pretty dramatically in the past year and a half or so. So you can't technically refinance a 401k loan. However, if you had a loan beforehand, it's probably at a higher rate. So if your plan allows you to either pay off a loan early outside of payroll, or if it allows for multiple loans, you can pay off your original loan, before the maturity date, which would have a higher interest rate, and take out a new loan for that amount, which would likely be at a lower rate, since most 401k plans base the interest rate on the prime rate or the rate you could get for a similar loan at the time.
Well, that was fascinating. So if you have any further questions regarding the CARES Act and how it may have affected your 401k plan and your taxable income, we're always here to help at LGA. Thank you so much for joining us, and I appreciate your time, Adam.
Thanks, Shannon.